The Money Show.
Personal Finance with Warren Ingram.
Been a heck of a week. It certainly has, in terms of investments and the value of the shares that you own in your pension fund, or you may have shares directly on the JSE. It all started this time last week with Silicon Valley Bank, and there was panic in the United States on Thursday and on Friday. Markets were calmed over the weekend by U.S. authorities who stepped in, did all the right things. Things seemed to be settled by about Tuesday. Then on Wednesday, Credit Suisse was suddenly in the crosshairs of the global investing community, and sheer terror and pandemonium and panic again. And things have calmed down there after the central bank in Switzerland has stepped in and offered a lifeline to Credit Suisse, which shouldn't be too big to cause havoc in the world, but there's just so much nervousness about at the moment. Warren Ingram at Galileo Capital. Before we talk about other investment opportunities, how calm are you feeling about the state of investments, considering that today, for the year, we are in the red after being 13% up mid-January and feeling a little bit clever and a little bit bulletproof?
Well, maybe we need to just talk about January then, and how we feel now, because I feel January was sort of a collection of classic rookie errors by global money managers. You know, we must remember we live in a place that understands inflation, understands really volatile currencies and interest rates and all of that. But if you're a money manager living in America or the UK or Europe, and you're sort of 40, 45 years old, and you think you understand this money business, the one thing is you haven't been managing money in a rising interest rate and rising inflation rate environment. They've actually only seen it happen to those pesky emerging markets far away from them, or they've seen it in their CFA textbooks. They haven't really seen it in the real world with real money. And so they're making the rookie mistakes we would have all made as money managers in our very early years of our careers. And fascinating to watch, because they keep sort of forecasting the end of inflation as if inflation is a switch that you just flick and all of a sudden, it's over and we can carry on as if nothing ever happened. That's just simply not true. And for me, January was exactly that. It was just excess optimism about an inflation rate number that was fractionally better than everybody thought. And all of a sudden they thought this was it. It was the beginning of good times again. And so fast forward to now, certain things are starting to break because interest rates are rising. So we're seeing a couple of regional banks in the US. And then, if I remember correctly, SVB is sort of around the number 14 or 16 biggest bank in the US. But very specific, very particular kind of clientele, very specific market conditions, why SVB found themselves in trouble. And so, there was this sort of potential for contagion. The American government and Fed have done very well to put a lid on that. And Credit Suisse is, I almost want to say, a serial offender. It's a bit like the Greek government with their bonds. Credit Suisse have been in trouble for quite some time, and we shouldn't be surprised that they're still finding themselves in trouble. And their central bank, sort of steps in now and says, well, we'll give them the money that they need to get through this next batch. And the reason why Credit Suisse particularly causes a lot more kind of flutters for a lot of people is it really is a big global player. So I saw a statement today from one of the very big South African fund managers that has a lot of its assets overseas, and they're a custodian for their clients' assets is Credit Suisse, and they're putting out a note saying, please don't worry, your assets don't form part of Credit Suisse's balance sheet. We are monitoring, et cetera, et cetera, et cetera. So the system is very interlinked. Long answer to your short question. I'm actually feeling okay, Bruce. I think for us, managing money in South Africa, and looking at the world and saying, well, hang on, we all manage money overseas as well nowadays. We actually understand this environment really well. What we didn't understand was sort of 2008 to let's say 2020. The world was sort of completely upside down for us, and birds were flying inverted, and the sky was green and the grass was blue. Now everything's back to normal, and I saw a tweet from Wayne McCurry, who I really think is kind of the sage of Joburg. And Wayne saying, listen, this is a buying opportunity. You will regret not buying shares now because it's very similar conditions to not the same movie, but similar sort of movie to 2009. If you don't buy now, you will regret it. And I think I'm not nearly as smart as Wayne, and certainly not with his experience. And I think he's absolutely right. So I'm calm. I think we should really understand this environment very well, South Africans. We look at what's going on overseas. They don't understand volatility. They don't understand kind of life and death. We just have to drive to work and home again, and we understand life and death perfectly. And so this is just not such a big issue for us. And maybe I'm too calm, but I feel we've watched this movie many times before. I think the foreigners are panicking, sometimes with a little bit of justification, but actually they're giving us some quite nice opportunities to buy some good assets all around the world, including SA, at great prices. And my eyes are lighting up, and I wish I had a lot more kind of disposable capital lying around, to buy now. I think it's a good time to be a buyer.
Wayne specifically, and here's the tweet, I read it earlier, but let's reread it. Buying opportunities, general mining, platinum, SA banks, don't panic and take money offshore. Rand is very undervalued, and if history is any guide, will be strong over medium term. All of this is a cycle. We're at the bottom now. Markets / Rand down. Cycle will turn up relatively soon. And you feel comfortable with that as an assessment based on what we do know at this particular moment in time. Things can change, of course, on a ticky. So what are you thinking about where to put money? Because at one point you were thinking that global bonds were looking attractive. Do you still have that sort of frame of mind versus SA Inc.?
I don't think it's global bonds versus SA Inc. I think it's, to me, it's about saying with your global money, for the last decade, pretty much there was this phrase which was really cute, return free risk. And in other words, you buy bonds overseas, and all you're going to get is no growth and a heck of a lot of risk. And for about 8 years, that looked like a dumb, cute statement. And then all of a sudden, it looked like a really smart, cute statement, because that's exactly what happened. Global bonds lost a lot of money because interest rates started to rise. So for a lot of money managers who've avoided, investing in global bonds altogether, I'm suggesting now that, if you've only owned shares and maybe your decision was, I don't want to buy bonds, so I'm going to have shares and cash, and you're sitting on too much cash overseas, I would suggest you reposition. I think, it's nice that you can earn, I just looked at it before we went on air, and it's about 4.66% a year to invest in dollars for about 3 months. And that's a very nice return, when the world is falling apart, and it seems very attractive. But just understand, inflation in the US is much more than that. And so you're going backwards at a rapid rate by sitting in that kind of cash. And I think, bonds, we might see interest rates rise a little bit more in the US, but what we do know is the bulk of interest rate hikes have already happened, which means that those bond prices are largely discounting, whatever's going to happen. In other words, if there is another 0.5% from here, fine. But maybe it's a good time to kind of switch out of cash and global cash and go into bonds again, and kind of that long term, 60% shares, 40% bonds, which is the kind of traditional good mix, good balanced portfolio. I think it's alive again, and probably will be a good place to be for the next decade. I would hate to say do that at the expense of SA Inc. I think it's it's the one plus, one and, not one or.
No, and this is the thing, because, one of the reasons why the Silicon Valley Bank went bust was because when money was free and cheap, they were putting money into long dated bonds, and suddenly people were putting money in deposit with them. They were using that money to buy long dated bonds, and suddenly interest rates start going up. People saying, "Ooh, I'm not getting a great return from Silicon Valley Bank. I'm going to withdraw my cash and put it somewhere where I can make some money." 4.66% over 3 months, for example. So they start taking money out. Next thing, everybody's taking money out. They can't sell the bonds that they've got in their portfolios because they're there for the long term, and suddenly kapoof. It all goes pear-shaped, and that's dangerous, isn't it? It really is dangerous. But from our perspective here, Warren, Wayne in his tweet, and the bit you didn't mention but I did, is don't take money offshore right now. The rand is at, let's be precise on this one. Sorry, that's the background music filling in while my app loads up. The dollar at 18.44, the pound at 22.30. and the euro at 19.55. Considerably weaker than a month ago, considerably weaker than this time last year. What's your view on exercising the strategy where you take advantage of the bargains Wayne points out, but also want to move some money into some of these global bonds because that's your money that you might want to make part of your global assets?
I think you've got to. I know you're sitting, so I know you won't fall off your chair when I tell you this. But my view is the rand dollar exchange rate, the sort of fair price, measuring the Big Mac index version of this, the purchasing power parity, is still going to be somewhere around 16.50 to sort of 17 rand to the dollar. And I'm not sure when the rand gets back there, if it gets back there next week or next year, I don't know. And around 20 rand 50 to the pound. And so I think, just be careful with big currency moves from rand to those two currencies now. I think you can afford to be patient, and you can afford to listen to people like Wayne who are giving you very good pointers there. I think we've been saying the same on the show for quite some time now, and just wait. The rand will come back to you. We just don't know exactly when. And then looking at the JSE, just remember, we're in a point where we've kind of got survival of the fittest, alive and well in our stock markets. If you look at some of the businesses that have been reporting, I just think about the banks. Last week a lot of the banks were reporting record profits, and some of the companies are sitting on huge amounts of cash. They have outcompeted, outsurvived all of their competition, are now incredibly fit, strong, battle-tested management teams. Yes, the economy is a massive headwind for them. Yes, no help from government, despite the pretty words they keep talking. But these are companies finding ways to make money. I know it's going to be a cliche in about another 3 weeks' time, but just look at what Bidvest did. Look at the results they got from kind of being open and alive to opportunities. And I think lots of good South African companies are doing that. So they don't need the economy to be growing really fast to make money. They have watched their competitors fall over, both listed and unlisted. And I think it's a case of saying, don't just exit, SA now. I think, the world will move away from developed markets again with a portion of their money when all these interest rate hikes are done. And they'll be looking for yield. They'll be looking for growth. They've got massive problems all around Europe and the US. And at some point, they're going to look at the emerging markets again, and we'll benefit from that. So I believe that JSE is really, ridiculously cheap. And I certainly wouldn't be piling out of all of my money out of South Africa, despite what some of the talking heads keep saying. I think this is still represents a good investment opportunity. But I think it's a case of have some in SA, have some global. If you've got nothing overseas, wait a while for the rand to come back. If you can't wait a while, then take some of the money and spread it out every 3 months. Send some money out, in 3-month batches over the next 9 or 12 months. And hopefully, towards the end of this year, your 12-month period, you have got some better exchange rates than now. But if you can afford to wait, or you've already got some money overseas, I think we'll be buying rands at much better, dollars and pounds at much better exchange rates than we're seeing now.
Lovely. Question from Anton for you this evening. We'll give you a moment to chew over this one, Warren. Anton is a trustee on the body corporate of a block of flats. Well done, Anton. It's a pain in the neck job, that, and you've put your hand up as a volunteer. We've been building up reserves for emergencies and are concerned we can't invest it optimally. If we invest in a fixed deposit, the interest rate from, say, Standard Bank is currently at about 8.63% after compounding for 1 year, 11.62% for 5 years. We don't plan to use the money in the short term, but may be forced to use it in an emergency. Critical point. I've seen reference to a penalty of at least 450 rand for early withdrawal, but not a definitive statement of how the penalty might be calculated. Do you have any recommendations as to how to invest this money for maximum growth while retaining access in case of emergency? It's a great question, Anton. That question answered by Warren, I hope, if he doesn't mysteriously lose his connection in a moment. Anton is a trustee of a block of flats. They've been building up reserves for an emergency. They want to invest the money to get a return on that, in other words, to grow the money they've got. They want to be able to access in an emergency. Where on earth do they put it? Warren, help.
Emergency funds, whether it's for an individual or a body corporate, the one thing you really can't do is lock it away in a fixed deposit. Definitely not a 5-year fixed deposit, and I would be really uncomfortable even in a 1-year fixed deposit, precisely because
it's an emergency fund.
Yeah, and you don't know, and you don't want then to be negotiating terms and conditions with the bank because they know they've got you over a barrel. And believe it or not, they don't always do the best for you when you have an emergency. So I feel I would look at a class of unit trusts called income funds. They're quite a big selection. I can't remember the number, but sort of 30 or 40 of them. And if you look at the returns that they're offering, just the average one is generating about 6.33%. That's the average. The best ones are right up at that 1-year number that Anton quoted at about 8.5 or nearly 8.7%. And then the worst ones are slightly lower than the 6% average. But the truth is that your worst case is probably 3 or 4 days at absolutely worst to get that money out, and no penalties, no transaction fees, and to me that's what an emergency fund should be. It's, you earn a decent rate of interest. You're happy to sacrifice a little bit of maximum growth because actually you just want to protect yourself as a form of self-insurance against having to borrow money at a really bad time when the wheels are, or in this case the geezer's fallen off or whatever it is, and so Anton, I would say don't lock the money away. If it's a large amount of money, then potentially you could try and shop around for a slightly better yield with a portion of the money and lock that away in a 1 year. But I would guess body corporates, that they shouldn't be sitting on 3 or 4 years worth of expenses. They need to then reduce their rates a little bit or levies to members for a year or two. But I would say for a year or two's worth of expenses to sit in a income fund, to me makes all the sense. And then I wouldn't take risk. For example, one of the things we could have talked about was a low risk balanced fund where you've got some exposure to shares. But the last week has taught us that that's not a really good idea for an emergency. So
the temptation now is, of course, well, Wayne said they're buying opportunities, so let's go and buy into their balanced fund now because it's down 15% from where it was at the beginning, from its peak, and therefore the only way is up. And does it matter which income fund you buy? I mean, there's the SA income fund, the enhanced income fund. They come out with the fanciest names and things, and I just wonder whether it makes a fundamental difference where you go in terms of these income funds. They're kind of much of a muchness. Some will be not even like fractions of a percentage point better than others.
Yeah, I think that's very true especially for money market funds, Bruce, because their sort of range of options that they can select for their portfolio is very narrow. But income funds can be a little bit wider, and you correctly point out there are lots of unit trusts with the words income funds in their name. So I think it's really important that when you look for these, the category, that's the ASISA category, is it's MA income funds is actually what you're looking for, because it gives fund managers in those unit trusts a little bit more flexibility to kind of choose very short-term money market instruments to slightly longer term, but without very big risk. And there is a little bit of disparity in returns. Let's just say sort of 3 or 4% between the best and the worst. I tend to prefer the bigger funds where they've got some critical mass. They've learned how to control the costs of the funds, because what you don't want to do is buy an income fund that costs you 2% a year, because that's just going to destroy all of your potential inflation beating growth. So I think you're looking for very low cost income funds, and bigger ones are in this instance better. They can the bond markets and money markets are really big. So size is not an impediment to performance for an income fund. Might well be for an equity fund. So I think big and decent track record, and definitely not last week or last year's number one. You're kind of looking for the funds that are generally in the top 25% of performers over long periods of time.
Talk to me very briefly about tax, please, in terms of how the tax on this would work, particularly when it comes to not a personal tax issue, but certainly the taxes of a body corporate. You can't be making too much money here, can you?
I'm actually completely ignorant what a body corporate would be taxed. I don't know
that's
if it's a
fine.
company,
Okay, but for you, then for you and
company.
me, I mean, any interest we earn on our cash, we've got a tax-free amount, and then any amount over that, of course, is taxable as income.
Correct. And so, these are nice interest rates to earn for a small portion of your money. You don't want to pay half of it away to SARS. We like SARS, but not that much. So this is a great place for an emergency fund, very limited role in your money. The rest, listen to Wayne.
There we go. Listen to Warren as well. This Warren and Buffett. I mean, they're both smart. Warren Ingram, thank you. He's the director at Galileo Capital. Bring us to exactly 8 o'clock. Time for Eyewitness News.